It's always a pleasure to have you, DK. Welcome back.
Nice to see you, Carl.
You were talking to Jim during the commercial break about, we'll get to this tactical list of upside ideas, but in general, given your targets and Jan Hatzius's GDP view, you've gotten more cautious, have you not?
Yeah, I think you want to be thinking about the S&P 500 trading in a range of sort of 3,700 to 3,900. This is basically because to the extent that equity prices rise and valuations increase, then you'd be tantamount to loosening financial conditions, which is not what the Fed is trying to do. They're trying to tighten financial conditions, slow down economic activity. And as a result, to the extent that equity prices kind of move to the upper end of that range, that's sort of more of a concern from a prospective forward return concept. And when you get the lower end, then it's sort of more attractive. So in that sort of range where we've been for a while, we think about the risk to the downside would put the overall index perhaps at, say, 3150, so a pretty meaningful downside. To the extent that we'd look at a recession in 2023. It's not the baseline forecast, but as you indicated, sort of the increasing probability of that.
And that was 225 times 14, right? Was it a 14 multiple?
Correct. We think about the idea of the market basically was derated from 21 times forward earnings at the start of the year to around 16 times approximately now. And to the extent that you had a recessionary scenario that one would look at, you can see multiple go down slightly. And the idea of earnings prospects would also be degrading.
More short term, is it your view, is it the House view that tomorrow's CPI will be, albeit hot, maybe the last of the hot?
Well, the expectations, certainly from the economics team, is that you'll have a very high headline CPI number. Core as well would be pretty high. And as a result, that would lead, the idea of the Fed continuing to hike 75 basis points in, basically in July. And basically you have another 50 basis points in September and then 225 basis points increases respectively at the towards the end of the year.
Is this dollar move in these stock prices and these earnings estimates yet?
You can really see that in the companies that are selling abroad and how much headwind they've had in terms of their performance compared with those that are domestically facing. There's been a huge gap, almost 10 percentage points difference in return. The export-oriented companies down around 24% or so year to date. The ones that are more domestically facing were basically down around 10 to 12%, which I think is a pretty significant indication that the equity market has reflected the idea of a really strong dollar has been a headwind for exporters.
So would you be a buyer on any bad news around currencies, for instance? I'm just trying to figure out how, a lot of companies do get a pass sometimes when they report. Pepsi today had a 2% hit on sales and on profits because of the strong dollar.
But they had very strong results.
Up, right.
Correct, and they reiterated their guidance in terms of their uses of cash for the coming year. They got dividends up 7% this year. At least that's in the model that we have. That our colleague Bonnie Herzog, who's our analyst, covers it.
Yes.
And the idea of business, they both report a returns as well as a constant currency, both earnings and sort of nominal terms and then constant currency terms. So basically, business has been pretty strong. I think the big takeaway I had in terms of reading the note was that business actually was quite strong. And the concern that so many businesses have heading into the second quarter results, and earnings season kicks off really on Friday. You've got expectations of around 6% year-over-year growth. That's still relatively modest. In the first quarter, expectations were about plus 5%. They came in closer to plus 12. So companies were able to manage through the challenges. The thing about the concern side will be in the second half of the year, in both the third and the fourth quarter, likely to get a series of negative earnings revisions because the idea of the economy is slowing. The analyst expectations are in double-digit growth. Highly unlikely that's going to happen. You've got big margin pressures that are coming from labor costs still. You have commodity prices, the dollar. All those are sort of headwinds for a lot of companies, and therefore margins become a central area of focus.
Shepard Smith here. Thanks for watching CNBC on YouTube.